Good afternoon. Today is Wednesday, November 11th, 2020. I'm Joe Terril, president of Terril & Company, independent wealth managers in St. Louis, Missouri. This is another in a series of our updates in these extraordinary times we're living in concerning our outlook for the economy and also investment markets. But before I do that, I would be amiss if I didn't stop, with today being Veterans Day, to thank all of the women and men that have served in our military for their wonderful service to our country. Moving on to the economy around the world, there are worries and concerns that we're going to have another lockdown because of the surge in the number of people testing positive in Europe, the United States, in Brazil, in India, and other places around the world. We do not see that happening. There are going to be some closures, but we do not see another hard lockdown. The reason for our belief is the fact that the severity of this disease is not what it was earlier this year, meaning that in April and May, for every 100 people that tested positive, 14 of them were ending up in the hospital. By the summertime, we were down to only 8 people. Right now, it's only 1 person per 100 that's ending up in the hospital. That's not to say that hospitalizations are not up. It's not to say, unfortunately, that even deaths are not up. They are, but it's a function of how many people are being tested positive. So we do not see countries saying we need to go back to another hard lockdown, which would stop the economic progress that we've seen in the last 5 or 6 months and actually send the worldwide economy into another tailspin. Right now, the economy of the world is running at about 80% of what it was at before the pandemic hit. We think there's great recovery potential when we get the pandemic in the rearview mirror. Certainly, some of the news recently on vaccines is very positive, and we do believe that between the major world pharmaceutical companies, that one of these vaccines is going to prove effective, and we think that by next summer, we will have this in the rearview mirror. And consequently, the improvement that we have seen in the world economy should continue throughout the first 6 months of next year, all the way back to where we're running, quote unquote, at normal. With that said, in the investment markets, we continue to believe that we want to be invested in the companies that are most tied to the economy. We want to own banks, we want to own paper companies, chemical companies, energy companies, and yes, even some of the airlines and entertainment companies that have great recovery potential when things, quote unquote, can go back to normal. What we want to avoid is the glamour high technology stocks that have had a big run to prices that make no sense. It's not to say that some of these companies aren't good companies, they are, but they're not worth any price that someone's willing to pay for it. There has been a lot of momentum being played in these companies, and we think that is coming to an end. In the last week or two, we've seen this shift from growth stocks to value stocks, and we think that trend is going to continue and maybe even accelerate as we get into next year. So with that said, I want to touch base for just a few moments on our inflation outlook. We've talked about this in all previous videos, and we have not changed our mind in the least that worldwide we will see higher rates of inflation, and when we do, interest rates are not going to stay at zero. Long-term interest rates have already begun to move up a little bit. A 10-year Treasury bond that a month or two ago was yielding 0.5% is knocking on the door, being back to 1%. Granted, historically still incredibly low, but it's the direction that we're talking about here. A 30-year Treasury bond that was at 1% is up to 1 5/8. As inflation picks up, these interest rates will move higher. So it preaches for a lot of caution in what is done in fixed income accounts. We continue to want to hold somewhere around 7.5% to 10% of our portfolios in gold or other assets that protect the value of our portfolio versus a weakening currency. If we see another major stimulus bill in the United States, not here to debate whether it's needed or not, just here to simply point out that those stimulus bills that inject $2 trillion, $3 trillion into the U.S. economy, that's printed money. No one did anything productive for that. The central bank simply printed the money, injected it into the economy. You cannot do this forever without devaluing your currency. And this is happening around the world. So we think it's something to be very concerned about, and we are aware of it, and we are taking steps within the portfolios to protect for that. So with that said, we overall continue to remain bullish on stocks. The stocks, again, that are most tied to the economy, that are still down 35% in value from where they were in February. And in fixed income, very short maturities, only floating rate paper, and no desire of any kind to reach out and extend maturities to try and lock in a higher interest rate, not with interest rates at all-time record lows. And we will monitor inflation and protect our portfolios against that. So overall, again, we see very much an improving world economy. We think the worst of the pandemic is going to be quickly behind us, and we're very optimistic on a world economic recovery. With that said, thank you for joining in on this video, and we'll be back in 2 to 3 weeks with another update. Thank you.